Hey guys, welcome back to another episode of the Mogul Marathon Real Estate Podcast. I'm your host, Yannick Cudjoe-Virgil, and I'm super excited for our guest today. Another successful real estate investor, entrepreneur. His name is Jason Stubblefield. Now, Jason has been investing in real estate for over 10 years now, so a lot of experience. He started off in single family homes and has since moved into the multifamily real estate space where he has scaled his portfolio to over 1,000 multifamily units in just a few years. So Jason grew up in a lower class family and was always mindful of tenants that he served. That led him to the transition of his company into affordable housing. So his company now is devoted to helping solve the affordable housing crisis while maintaining strong returns for his company and his investors. And he is also a U.S. Marine Corps veteran. Jason, welcome to the show.
Yannick, thanks for having me, man. Glad to be here.
So, Jason, I know you're also a huge fan of my prior team, which I played for, the Tennessee Titans.
Let's go. Tighten up. You know what I mean?
And you and I met, a few years ago, back when you used to live in my area, the Washington D.C., Maryland area, and we met at your meetup. But I'd love for the listeners to learn a little bit about your background, who you are, and where you got to, how you got to where you are today.
Sure. Yeah. I was, grew up lower income. Really, just tried to get started. I spent some time in the military. Did 4 years in the United States Marine Corps. Shout out to all the Marines. From there, I ended up getting a degree in computer science. I was up in the DC area actually doing software development, government contract, and living in that world. And I really got into real estate, wanted to just make a better life for myself, was tired of a W-2. And so that led me to invest in single family first. Then I saw that was going to take me a lot of time to try to hit my goals. And so this is over, probably almost a decade of time. But once I realized the single family wasn't going to work, I went into multifamily, and then I've been there ever since. So I started, my first investment was in 2016, and I grew the portfolio to a little over 1,000 units. And that's what I'm doing full time right now. I'm buying apartments and looking for advantageous deals.
That's amazing. So give the listeners a little bit backstory of like how are you able to jump out of the single family space and grow that portfolio to 1,000 units? For many people, that might be like a daunting task for them. How am I going to get to like 1,000 units? But maybe you can share a little bit inside of like, what that journey was like for you.
Sure. Yeah. So it definitely wasn't straightforward. And when I was investing in a single family, I really wasn't making much traction at all. Right. I had a few rentals, maybe like 3 rentals. And then I did nothing for a long period of time. Right. Because I got married, I had kids, and I also didn't have enough money to afford the 20% down payment to go do another investment property. And so this is all while the market is still rising higher and higher. So
Mhm.
once I finally decided to get started, I was looking at some guys, some neighbors that were around me, and they were doing real estate deals. And I was like, how are you doing this? What are you doing? They told me about some of their resources. They were really into podcasts. And so I started tapping into some of those podcasts, learning. So good thing that you have one like this, because I'm a witness that information can change your situation. So
Mm.
that was really what got me started. Once I got started back and trying to figure out the single family investing, I was like, it's going to take me a while. I did the math, and I was like, if y'all making $300 per single family home, and I was lucky if I could do that, it was just going to take me a while. So I started just consuming a lot of information. It was like, all right, well, how do I learn how to do this? Or maybe there's something else. And I tried a bunch of different things, sold Amway and all types of crazy things that didn't amount to much. But when I found apartments, I got something that I could get excited about because I felt like it could work. So I started off with one property that was about the most expensive property I could afford. I had to leverage some of the equity I had in those single family homes in order to be able to get into the deal. That's the way I got in. It was a beat up property, 50% vacant. And I learned a lot, right? I made a ton of mistakes on that project, but I also learned. And from those lessons, it led me to try to do more, right? And I got to a point where I'm reaching out to people I network with, and I was like, I really would like to do some more real estate deals. However, I don't have any money. All my money's tied up into this 34 unit apartment complex. And they told me, well, you could look to partner with other people or syndicate. And so the scaling really happened after that. Once I was like, okay, if I can leverage other people's money, then I can do more deals than just the deals I have the capacity to do with my own funds. So after that, I learned the syndication model. I immediately went to go get a coach because I didn't want to make those mistakes with other people's money, right? It was damaging enough to hurt my own pockets. I didn't want to hurt anybody else's. But I got a coach. I learned how the syndication model worked, had somebody who could look over my shoulder on my next deal. And that's what led me into syndication. So it started with one syndication deal. And then I was able to partner up with some other groups. And that's what led me to doing larger apartment complexes.
Yeah, that's a great story, and I like how you said information can change your situation, right? Because there's really no excuse here in this world where we have everything on our phone. I love YouTube University. I'm not afraid to say that. There's just a plethora of information out there that can help you change your situation. And so, talk about like that first deal that you said, the 34 unit. You know, that must have been a stressful time taking on that type of asset. Did you say 50%
Yeah,
occupancy?
50% occupancy. Yep.
So what
Yeah.
made you jump into a deal like that, you know, for your first deal? Did you see like some opportunity in it? Um yeah.
I was really hungry. You know what I mean? I felt like I did some investigation into 401ks. I'm like, this is not going to work. And so I was trying to just do something. And what happened was I had a couple of fourplexes in Memphis under contract, and they fell out of contract. Right. So blessing in disguise that I wasn't able to buy those. So being a sort of disgruntled from losing out on those properties, I just called on this property that I had seen multiple times, right? It's just been sitting on the market, but I'm like, no, that's too big. I'm not looking for that right now. But I just called to see. Once I talked to the broker about it, I got excited because I was like, wow, there's some real opportunity here. And it was a little bit of just being naive is about why I did the deal, because I was like, I didn't know some of the things to look out for. I was like, okay, 50% vacant. I just saw that basically I was a glass half full type of guy. I'm like, all right, well, that's just all upside for me to go take advantage of. And then, once I got into it, that's when I started learning, like, oh, okay, there's a reason there's 50% vacant in it. And some of those problems were things that I had to solve. But that was it, man. Really just being hungry and decided I was going to do something. So I went for it.
Yeah, you know, it's something about the hunger sometimes, you know, as entrepreneurs can sometimes force us to overlook the dangers in this business as well, right? Um, because sometimes you just want to get that deal done. It's just that urge of like, man, I just want to get this deal done. But you mentioned it was something that, you know, helped you turn around your thought process maybe in this space, or turn around, you know, how you viewed investing, and it probably made you a better investor, didn't it?
It did. It did. I learned that it's not all peachy and creamy. You know what I mean? And it's not like just because you say you own something that you necessarily profit from it. And that was a big lesson learned.
Yeah. So I know that you're in the affordable housing space, and some people, when they think of affordable housing, or I think most people, because market rate affordable is likely the more um preferred investment strategy amongst, you know, your typical investor. But I know you're in the light tech space as well. You know, give some folks the difference between some a concept or some information between market rate affordable and light tech affordable.
Sure, sure. So affordable housing at its purest form, like really general, it's just saying that the rent that you're paying is about 60, not 60, sorry. It's about 30% of your income. So that's from the government saying that the average American should be able to spend about 30% of their gross income on rent. So if you are paying rent at 30%, you are living in what we deem affordable. And so there's a lot of other terms around it, like workforce housing and even C-class properties, right, where you're sort of catering to people who aren't necessarily making a lot of money. That's the umbrella of affordable. But what has happened, what I saw in my career, was just that if you have a heart to serve that type of community, it's really challenging to be able to do it in the current market structure because pricing keeps going up and investors are seeking yield. So you're not doing a good job if you aren't raising rents, if you can get them, right? That's just how it goes. Market rate is simply that. It's what you can demand from the market. So to be able to buy deals and get returns is very challenging if you aren't doing properties where you're taking it to the maximum rents. And those maximum rents nowadays are forcing tenants to pay 40 and sometimes 50% or more of their income towards rent. So what I've gotten into is affordable housing and the tax credit section underneath that. So that is like a public-private partnership. And you have to work with governments to solve that problem I just mentioned about how making the capital stack work, being able to get investors yield and not necessarily having to increase rents. So I fought it for years, tried to do something about it, really didn't gain any traction there. But in the affordable realm with low income housing tax credits, that's a unique beast, but it allows you to be able to have some pretty nice properties that are done, that there's a lot of capital put into them. They're not distressed. And I want to just say that because a lot of people think, this is the hood projects, it's really beat down when you say, oh, affordable housing. And I want to change the connotation when I talk about it, because no, you've got A-class properties that are built in 2022 that are affordable housing. The type of projects that we're working on are not those sort of beat up projects, but things that we can go take and redevelop and make them just as nice as your market rate deal. So that's the gist of how it works. The umbrella of affordable housing, and within that you've got low income housing tax credits, but you've also got other government programs like project-based vouchers and various other government incentives to help tenants out.
Yeah, and there can be a lot of opportunities when you are able to take on an affordable housing project that has gone beyond that 15-year compliance period, right? From being able to take some of those rents that were under market for so many years, because like you said, in the affordable housing space, you have different, AMI brackets that are devoted for that particular, for a certain subsection of individuals, right? It depends on how the project was created by the developer. And being able to take advantage of the rents, the delta between under market rents versus where the market is currently at, I'm sure there are a lot of opportunities that you might be seeing in that marketplace today, correct?
It is, and that's sort of untapped potential there. And is that just because something is affordable doesn't mean there isn't untapped value in it. So affordable isn't necessarily locking rents where you can't touch them. It's just saying that we're going to cap rents and think of it as like a rent cap. So we don't want rents to be, say, over 60% of the area median income. So as long as you're underneath that, you can stay in those properties. So you're thinking about your waitress, hostesses, school teachers, right? Policemen, people who are working jobs, but they just aren't working jobs where they can devote $2,500 a month or whatever it is into rent. So we provide housing for those people who do have income, but just could use some assistance and a break on the rent.
Yeah. I think it's a great way to have that double bottom I investment, which is what I call income and impact, right? Being able to create the returns for your investors, and then also having that impact within the tenant base as well. I know within the LIHTC space, if someone is developing a project from the ground up and is doing the tax credit method, the cash flow for the most part isn't there. They make their money on acquisition fees, but as a syndicator, being able to take on a property that, again, has gone past that compliance period, there's certainly a lot of benefits, lucrative benefits to doing a deal like that. So one thing that I wanted to bring up as well, I know that you have experience in what we call lowercase affordable, right? Just market rate affordable. Um, how do you tackle like a affordable housing project or properties that are located in affordable markets, right? Maybe it might be a C plus, class market or B minus market. How are you tackling like the management for those types of properties?
Yeah, it's not easy, and you have to really look at your numbers. So one of the things that we do is definitely verification of rents. And it's not that you cannot it's not that you shouldn't rent to people, but you have to be a little bit more careful, because in some lower income, lower class, you will find tenants that may falsify W-2s or check stubs, right? And so we've had our property managers that have caught some things like that. And you definitely want to be verifying, calling employers, that sort of thing, just to make sure. You also have to have a management company that is going to have to work with the tenants, right? You don't try to relate to our property managers like you sort of have to coach tenants, because a lot of people, unfortunately, it's just not. Unfortunately, a lot of people aren't educated on financial literacy. They aren't aware that, hey, I should probably put my and maybe my phone bill or my car bill second, right? And if you're living off of a paycheck to paycheck every 2 weeks, just little things like that of seeing how they can get caught up, right? So there's actually a level of care that you have to take into C-class properties. There's some things that you can do. You may have to work with some people to allow them to pay an extra 200 or 300 to get caught up, so that they're paying their rent on the first, because people pay rent according to how they get paid. And so if they're getting paid every two, well, it's going to depend on where their check falls. And if their check falls on not the first of the month and they don't know how to manage a budget, they may be late, collect late fees and all that. So we try to educate people on how to get in front of that, be in charge of their budget, and sort of help them along. So it's managing your budget as an owner, but also trying to work with the tenants to make a good situation.
And that's exactly what I wanted to touch on too, because a lot of investors start off in the affordable, C-class markets. Some syndicators that might have to work their way up, could probably only tackle, a C-class project and then kind of work their way up to B to A. But my point is, you have to be able to like manage the C-class properties. And the first thing is acquiring that good management company who can handle those types of projects, right? Because not everyone knows how to handle C-class tenants. And it's not from a discriminatory perspective, but when you get into that certain realm of business, you have people who are living paycheck to paycheck. And what we do from an asset management perspective is that on delinquencies, we make sure that if there's anyone that's at least 1 month late or 2 months late, we put them on a watch list, right? Because it's hard many of times for those folks to catch up without doing some sort of payment plan a lot of times. Or sometimes they might be behind on rent and that balance might linger for the next 3 to 4 months, and giving them an opportunity to catch up, right? So definitely knowing what you're getting into in the affordable housing space, and then also understanding the tenant base as well, because like you mentioned, it's a lot of people in that community sometimes don't know much about financial literacy. And so it really comes down to being a solid and healthy operator. So what are your thoughts on that?
No, I think you hit it spot on, man. I'm interested in that watch list you got. The watch list, you got like their name on the outside of the building.
No, it's just no. We don't do anything like that. It's just internal,
I know you're not doing that.
Yeah, it's just internal, because I mean, at the end of the day, we're in this for profit. We want to make a difference, but we're also in it for profit. But we want to make sure that we provide the returns for our investors too, right? So on our weekly delinquency list, we're tracking all the folks who are a couple of months late, because I mean, we have to make a business decision at the end of the day, right? And you might be in a market where landlord laws are not as friendly as maybe some of those southern markets. And at the end of the day, it's about you protecting your investors and making sure you're able to deliver a good return. That's pretty much how we attack that, the affordable housing side of things. So,
No, I
what,
think you hit it spot on, and you touched on what I was going to say with the thoughts, right? About knowing your the market that you're in, because if you aren't in a market that's landlord friendly, that can really come in to bite you. And regardless, as you mentioned, this is a business, right? It's not a charity, right? So if you want to be an apartment owner and do charity, then do charity, but your property is not charity. So even though I'm in affordable housing, we try to communicate that to the tenants too. I think it's one of those things that you have to learn that tenants are your customers as well, right? And it's unfortunate about the financial literacy thing. So I'm really speaking on both ends of the spectrum right here. We want to treat our tenants well, and we want to give them every opportunity to succeed. At the same time, it is a business. So evictions, they happen, and we do them, right? A lot. But you want to you don't want to be so hard that you necessarily take somebody who's financially illiterate and just evict them without giving them an opportunity. And so you got to find that balance in between both of those. And so I think with
yeah,
me just coming from a background or even being raised in that way or having family in that way, where you understand that people just aren't aware. They don't do things because they're necessarily malice or in ill intent. They just don't know how to manage a budget. It's something that's unfortunately not talked about enough.
yeah, and that's a challenge in that space too. Is like, you don't want to kick anyone out of their house, right? That's the kind of like the conundrum that you're in. It's like, you have this fiduciary responsibility to your investors and making sure that they earn a profit on their money, but then also you have this ethical sort of like complex where you don't want to kick someone out of their house because you don't know, if they may be able to find housing, following that eviction, right? So I honestly think that it's up to government agencies to bridge the gap on supporting those tenants, right? Because there's a lot of time where government agencies like to intrude and create laws that make it tough for smaller investors, so to speak. Like, for example, the COVID requirements where you couldn't evict people for months, right? There are a lot of landlords that went out of business, quite frankly, from that situation. And
Yep.
majority of that was in the C class space. So I really think the pressure shouldn't be on the mom and pop owners or the smaller landlords that are investing in these communities to be taking on the brunt of the financial responsibility for for a tenant that is unfortunately unable to pay their rent.
Yep. I agree.
So let's talk about markets that you're investing in. I've seen you post on social about different markets that you're investing in and how you evaluate markets. Give our listeners a little bit of context of how you evaluate markets today and what markets are you currently investing in.
Yeah, yeah. So because of what we're doing with the tax credit, tax credits have some unique characteristics about them where you really have to know states. You have to know the state jurisdiction that's going to govern the tax credits. Because of that, we can't focus on all 50 states, and I wouldn't tell anybody to do that anyway. But we focus on Tennessee and Georgia because those are states where we feel pretty comfortable about what's happening in the government. Now, to just back out of that and just go to regular market rate or market rate deals or evaluating a market, we do that where we really get granular on that particular block, right? So it may be a great market. You could say Memphis is a great market, or even here in the Atlanta area, you have a great market. But it doesn't mean that every place in that market is a great market, right? It's very much block by block. So we use a resource called justicemap.org. And what I love about justicemap.org is that it allows you to look on a block to get the income. So we first start there. So dealing with what you mentioned, if you're going to be dealing with a C-class property or C-class tenants, knowing the income levels of those people is really our first metric to say, like, can they afford these rents? So if you buy in a place and say the average the median income is $40,000, and you're trying to get $1,500-$1,600 rent out of that market because you're doing a value add, where you're setting yourself up to fail because you're demanding too much based off the income level there. So we start there to see, do we have a winning play based off the price? And that's really level one. And then we also looked at crime. Do we want to be there? There's some areas that are borderline, and there's some areas where we just don't invest in because the crime is too much for what we want to bear right now. And so really starting off with those are the major the major factors. And then we sort of get broad, right? Where jobs coming from, what's population doing in those. But we know that on our markets really going in, when we get a property that fits our general criteria, that's when we get a little bit more granular and go into the crime of that block and the income levels on that block.
Yeah, no, that's a really healthy approach to evaluating markets. One of the things that you said was just the income, knowing exactly what that income is in that area, because that has a direct impact on your tenants being able to pay the rents, right? If you're going into a market that's developing, that is the incomes in the neighborhoods are developing, there's probably going to be some time for maybe some of that demographic to like catch up, right, to some of the demanding rents if there's a lot of people moving into the neighborhood or the area is changing. And I think that also goes in line with the affordable housing strategy, right? Like, for example, if you're investing in a market that is turning around, and the demographic in that area wasn't that that their income base wasn't that healthy compared to where rents are today and where rents are going, maybe you want to lease up some of those units Section 8, for example, right, just to kind of stabilize that rent and get that healthy kind of mix of tenants until you think that market matures, and now you have people who are coming into the neighborhood, who are taking advantage of the jobs that are in that market that can pay the rent at the new premium that you're asking for. So I think little strategies like that are super important, especially when you're investing in the multifamily space on a larger level, right?
Definitely. Yep.
So one of the things that I also want to talk about is the secondary and tertiary markets in today's environment. Are you also seeing opportunities in those markets as well, compared to maybe primary markets? Where are the opportunities in those markets if you're investing in them?
Yeah, I think secondary and even tertiary markets have deals. However, it used to be, maybe a few years ago, that you could run to the secondary market. That's where you got deals at, because it happened like the primary markets became oversaturated, got very hot, and then trickled down to the secondary markets and even got to the tertiary markets. So what I like to tell people nowadays is that your basic underwriting spreadsheet is no longer valid. Right? It's no longer that you can just plug numbers into a spreadsheet and then go make an offer and go buy a deal. Right? There's more a more deeper level of investigation that you have to do, right? Such as knowing the taxes, or having a tax consultant on your team. And a lot of people aren't doing that. And if you don't, what happens is you just end up making offer after offer, and you're not close, and you won't find deals in primary, secondary, or tertiary markets because you're always going to be way off on your numbers. So if anything, I try to tell people right now, it's not amateur hour. You know what I mean? Like, especially at today's prices, you really have to be sharpen your pencil and digging into each deal, which is why you try to focus on a smaller city or a smaller market, not to have 10 different markets that you're sourcing deals from. But try to stick to 2 or 3 is what I recommend. And out of those markets, then you can go really granular because you got some boots on the ground to confirm rents and be able to really fine tune your underwriting. Because if you're looking on the outside of a market, even when it comes to rents, knowing that there's an extra $50 rental increase that you can realize can oftentimes make the difference between your offer getting accepted or not getting accepted. Where somebody who's really plugged into that market, they know that. And so they're going to underwrite that extra $50 premium. If you don't know that, you're going to try to be a little conservative, and it's very competitive no matter no matter what type of market you're in.
Yeah, I think this whole connotation of like conservative underwriting that was in the this space, this real estate space, has it's probably almost thrown out the door. And I don't mean it from a fundamental perspective. I mean it from there's so much liquidity in real estate today. There's so much liquidity in the multifamily space today that you can't possibly be conservative on all your metrics, right? Because you'll never win any deals. And it just comes down to local market experience. You know, we've won deals because of that, being able to have existing comps in our market that we've obtained and being able to know exactly what we can get. And we have achieved those rents. And then also operationally, like you said, too, right? Knowing the taxes, knowing how much to pay people in the market, little things that can separate you in this environment, man. It's so important because everyone is chasing multifamily deals. The market is still competitive, even though we're interest rates have gone up in 2022. You really have to, I think, you can't be super overly conservative in today's environment.
No, you're spot on, man. You're spot on.
So how are you winning these deals given the fact that there's competition? What strategies are you using to win deals?
Yeah. That is, man, you asked some really good questions. But one of the things that I do is we're going hard on all our deals, right? So it's hard money day one. And if you want to get into how we structure that, we can a little bit. But that's one thing on our deals. It's the hard money day one. We also write a letter to the seller, right? And so a little bit about our company, what we're doing, try to get them to feel good. We also try to put proof of funds letter with that, and we also send our lender letter, right? So we have the loan size by a lender and we send that to them. So we really try to show in our offers if it's close, because this is the thing that happens in multifamily. If it's close, if you're offering 10 million and somebody else is offering 10 million, well, what's going to separate you? And oftentimes people will take a two or $300,000 haircut, believe that somebody else is actually going to buy the deal versus somebody else that they're a little fuzzy on. So we try to give the seller as much confidence in us as possible while making the most aggressive offer we can possibly make. And that's honestly what you have to do, in my opinion, to be able to win deals these days.
Yeah, no, that's 100% correct. There's a difference between, or I think that you have to kind of mix in between being strong on your offer, being submitting an offer that also makes sense compared to the competitive environment, and then also tapping into the emotional side of things with respect to the seller or the broker by creating that connection, leveraging those relationships, because there's certainly deals out there where people like yourself have won deals by not being the highest offer, but they know your track record, what you have done in the market that you're currently investing in, and that says a lot with being able to like win deals, because the seller wants at the end of the day to close, right? And going through like an entire 60-90 day process and trying to start that over again, all because the person that you that went with the highest offer probably may not have had the biggest credibility. But if you took that highest offer with no credibility, you're risking being able to close on that transaction. So that's
Yeah.
that's super important.
Yeah, absolutely.
So what deals are you working on today? I'd love to learn more about a light tech deal maybe you're looking at, or maybe our listeners are really intrigued on like the numbers of how they can make sense in the affordable housing investing space.
Yeah, well, we've got a deal right now. It's in Douglasville, Georgia, a little outside of Atlanta, about 20 minutes outside of Atlanta. Great suburb, but what we really like about it is just the fundamentals of it. It's remember some years ago when you could almost do the 1% rule on your property, like what you were buying per unit, where you say, "Hey, I'm buying something at call it 80,000 a door and rents are 900," and so you just sort of knew you had a deal because now I'm buying 100 units like that. Well, what we are finding is in these affordable market spaces, we're still able to find deals that have that sort of the fundamentals are intact. So this deal right now, we're getting it at we just got a price reduction due to negotiations and interest rate changes, but we're getting this at 64.5 thousand a unit, and rents are currently $745, and we can push those up to 950 easy. And so the fundamentals of that deal is good. I think it'll be a good move for our investors and the tenants too. So that's what we're moving forward with, and looking at other opportunities like that to in Georgia and Tennessee.
Yeah. So is that would you syndicate that deal, or how would you kind of put that deal together from a back end, side, from a logistics and
Yeah,
returns
yeah.
spectrum?
Yeah, so it's a little bit different because it has the tax credits, and a lot of times what market rate people would do is they like when they come out of compliance after 15 years, they'll buy those deals and then they'll take them back to market. Well, they'll wipe off the tax credits, renovate it, and now they're able to go get the rents that the market would demand, which usually makes them a lot of money. And I don't knock them for doing that, but because of a heartfelt mission behind doing this outside of just making money, I feel like we can do well and do good at the same time. So what we're doing is not taking them out of the program, but leaving them in the program while implementing the value add structure. So what we do is we look to hold it for a 5-year period, just like your basic sanction. But we also apply to the state agency to go in and re-syndicate the deal. And so what happens in that scenario, just to keep it simple, is we replace our syndicated equity with tax credit equity. So a tax credit equity partner may be like a Wells Fargo, Bank of America, somebody like that. They'll come in and get the tax credits. But what that does is it allows us to do an additional influx of capital into the project. So now we may take an additional $30,000-$40,000 a door, right? Because remember, we said these projects last for 15 years. So the foundation of it, or the principle behind it, is that you want to get this property ready for the next 15 years. So when you do that, you basically replace everything that's not going to last at least 15 years. So we're doing interiors, obviously, and paint and flooring and appliances, but we're also doing HVACs and roofs and windows. And so we really make a new pristine project and keep it for the long term, which is a win for us, our investors, and the tenants.
Yeah, that's a great strategy. Like I said, there are opportunities in the affordable housing space. Some people that may not know much about it, might be scared to invest. They just figure, hey, this is too much red tape, right? Because there's a lot of red tape when we talk about tax credits, from knowing your QAP in your local area, and for anyone that's that's trying to understand what QAP, it's qualified. What is it? Qualified allocation plan, right?
Yep.
So knowing that is extremely important. I mean, there's grant money out there that would help you, get some of these live tech deals completed, right? And
Yep.
so there's a huge push in the country to support affordable housing. I think it's a great way to invest in today's environment. So I want to switch gears a little bit into a little bit about something where you felt frustrated on your journey to where you are today. Maybe it was like some breakthrough moment that you had to push through, somewhere along the line where maybe you had to like develop some systems and processes to kind of get to the other side. Maybe our listeners today are going through like the same struggle, and they're just looking for some guidance on like how to get to the other side.
Yeah. Man, I got a lot of those. That's a great question. But I think that one will have with just being very efficient, right? So a lot of people in this space, you don't have the capital to start off full time. So you're doing this while you're working a full-time job. And as I started building a portfolio, started owning properties that demanded more time, and I was a one-stop shop. So it was like I'm doing the underwriting for new properties, I'm doing the asset management of current properties, I'm doing the investor emails out and working a full-time job while having a family. So that can be very stressful. One of the things that it forced me to do was really get into meditation. And maybe that's not what you're looking for, but you can find I found myself being completely over. I want to do this, and now I'm in it, right? I can't stop anything. Can't stop being the husband, the dad, apartment owner, whatever, right? What am I going to do? But it forced me to try to reach out for something else. Besides that, though, it was also forcing me to get really efficient with systems and building teams. And so with that, I started leveraging virtual assistants to sort of help me out, and then looking for processes so that you don't forget things. So really just a management structure. I use Trello boards, and I have a system within Trello so I can manage everything that I'm
I
doing.
love Trello, man. That's a gem right there. A lot of people don't know about Trello. It's a free software too. Free it's free on the website, but go ahead.
Yeah. Now Trello is awesome, man. It's a gem, right? But you can take Trello and just organize and be able to visually see what you're working on and see the process that is at. So I use that in order to try to keep up with things, because when you've got a lot going on, it's easy to forget things. And in apartments, things are pretty important. You know what I mean?
Yeah.
Investor emails are important. Managing your asset, checking your budget is important. So you don't want to let those things slip through the cracks.
Yeah, definitely. I agree 100%. I think it becomes tougher when you're doing larger deals, right? And you're bringing in investor capital. Someone that's like in the single family space, that's maybe flipping houses, or just has like portfolio like stabilized rentals. I think probably wouldn't be experiencing the the growing pains of someone who's syndicating and doing large multifamily deals, because someone has to look for the property, right? Acquire the property, go through all of that stuff on the back end, or sorry, on the front end, and put the deal together. And so a lot of times you do all this work not to even get a deal after you underwrite it for like 20 hours, and someone else has to, well, actually at the same time, you still have to asset manage, right? And that, typically in these deals, the whole period is like 3, 5, maybe 7 years. So someone has to asset manage these deals, and someone has to handle the investor communication, putting together those reports, sending them on a quarterly basis, trying to be on time, and like still managing all of that stuff while you're trying to do more deals. So I definitely 100% agree with you on the efficiencies and being able to like hire people and leverage virtual assistants to scale in your business. And one of the websites that we're using right now is called onlinejobs.ph, and we're able to get high quality virtual assistants that have master's degrees and bachelor's degrees, to get high quality talent for us to build those systems and grow efficiently. So man, that was a really good breakthrough moment that you shared with us today. If you were to start this whole marathon over, what would you do? What would you do differently?
I would have sought help from the beginning.
Yeah.
Whatever reason, I don't know. You just always think like, "Hey, I need to do this. I need to do this," and I was so stubborn that I did that until I could no longer do it. Right, and that's when you build a team and you have somebody that comes along. And you're like, "Oh snap! This is way easier now that I got somebody, somebody to help me out." And so that's what I would change from the very.
Yeah. Yeah, no, I 100% agree, man. Like I said, it's a lot of work doing this business, specifically real estate private equity. When you're doing much larger deals that involve many different moving parts, you really have to think about, how can I leverage partnerships to scale? How can I leverage partnerships to grow, and leverage other people's talent and other people's time to invest together to kind of build a portfolio. So that's really important there. So talk about your Facebook group, the multifamily code, and SNS partners, and how investors can kind of follow you and get in touch with you if they want.
Yeah. So jasonstubblefield.com is a website I created as sort of like a portal to allow people to get to however they would like to connect, right? So SNS Capital Partners, that's the name of my investment company, right? That's where we go out and we buy these affordable housing deals. So if you go to snscapitalpartners.com, you can check us out there, or just jasonstubblefield.com, you'll get there. Family Code is a community that I put together on Facebook absolutely free, just where I share information like this. So about underwriting deals, whether it's trying to make offers, some of the things that we covered here, I share tools and really anything that's on my mind just to sort of help people, because a lot of people are spinning their wheels, making offers that aren't getting accepted, or they just don't understand what can be done in multifamily. So that's something that I put together that you can tap into if it works for you.
That's perfect. That's perfect. So, Jason, thank you so much for being a guest on our show today. I mean, we've talked a ton about affordable housing strategies, different markets, how to push through um, things that you're going through in your business, and how our listeners can kind of benefit from you. So, thank you so much for being on our show. Thank you for our listeners for tuning in to another episode of the Mogul Marathon Real Estate Podcast. And just remember that real estate is a marathon. It's not a sprint. Thanks again, Jason.
Man, thank you. I enjoyed it. Tighten up.